Chris Wood of Russell Investments, you manage what, about 161 billion.
Correct.
Make sense of what's happening on a day like this.
I think on a day like this, you're just seeing a response to softening economic data. The global growth story is not going into recession, but it's slowing down. The U.S., again, not going into recession, but it's slowing down. I think this is going to be a continuation of 2010, very sloppy, choppy economic data. It grinds upward, but there's going to be some soft months.
Okay, now why grind upward? I mean, what out there gives you any sense of optimism?
I think if you're looking at a lot of the restructuring that's taken place in corporate America, they're the leanest, the meanest they've been. They've reissued or retired all the debt they want to.
If they're the leanest and meanest, they can't get no leaner.
Correct, but that also means they don't need to have this huge, massive GDP recovery in order to be profitable. So they're sitting on a lot of cash, written down a lot of debt. So I think for corporate America, that's kind of counterbalancing what we're seeing happening in housing and unemployment.
All right, Steve, but if they're lean and mean, I mean, you just brought it, housing and unemployment. I mean, if they're not hiring, they don't feel good enough to go out there and hire aggressively, that means we don't have a lot of consumers spending stuff. Ultimately, that's going to feed back to the companies, and they're going to get a little nervous.
It will be. It can't go on forever. And what we're seeing in the unemployment arena is that there's a lot of structural as well as cyclical unemployment taking place there. And if you're a corporate right now, the incentives to go out and hire are rather small. You're probably running 100% of revenue from 2007 levels off of current staffing. And given questions in taxation, healthcare, Obamacare, there's a lot more question marks than answers. So taking on a new employee right now, given soft demand, is not a primary focus of businesses.
All right, maybe not a primary focus of business, but we had a guest on earlier whose primary focus is to look at the markets, and he's been looking at the markets. I'm talking about investor Jim Rogers. He wasn't even coming close to being complimentary about U.S. stocks this morning when he spoke on Surveillance Midday with Tom Keene. Listen up.
I don't own any stocks in the United States. Tom, we're the largest debtor. Things are getting worse. The Japanese lost 2 decades when they tried to prop up failure. We've already lost 1 decade. We're going to lose another decade.
Hey, Steve, are we on track to lose another decade here in the United States?
I think another decade might be a long time, and it depends on what you own, too. And that's the second time I've heard Jim Rogers say that just today. And from a global perspective, we would agree that, you want to be globally diversified in this environment. Now, the United States has gotten very cheap relative to a lot of areas in the world, relative to Canada, relative to Australia, relative to China. So I think there are some stock-picking opportunities in the United States. So I think it really depends on what you own to make that blanket statement. But we do prefer having a globally diversified portfolio. Although there could be some repatriation as the dollar gets weaker, those earnings look better. But as the dollar begins to improve, it may not be so attractive to be overweight too much outside the U.S.
In other words, you actually want the dollar to stay weak because companies that are selling abroad effectively repatriate and it makes profits look higher.
Exactly right. So you get the same amount of sales in a foreign country, but if the dollar goes down, those earnings look like more dollars when you bring them back in.
Hey, I want to also bring in Sheila right now because we're talking a little bit about global perspectives and investing globally. I mean, Sheila, you've been watching the emerging markets for us here on The Close. Talk to us a little bit about what we're seeing right now.
Yeah, things not looking so hot when you're talking about the emerging markets. In fact, they've been down for about 3 days in a row. In fact, take a look at the Msci Emerging Markets Index, falling about 2% today. A lot of trends happening. First of all, you have overheating in economies like India and in China. Central banks there really pushing back when it comes to rates. India now actually reflecting an inverted yield curve. And China, we're getting some data overnight. Exports have slowed down, but imports, on the other hand, have picked up quite a bit. Perhaps a suggestion here that China is on its way to becoming a self-sustaining economy. Stephen, my question to you is, where do you fall when it comes to the emerging markets debate? Are things just too overheated there, or is there still lots of opportunity?
I think there are opportunities if you've got a longer time horizon. And this kind of plays out the previous question, I think, looking globally, that right now emerging markets, China, Brazil, they've got a lot of headwinds. They're aggressively raising interest rates. Their governments are trying to slow down their overheated economies. And they've got rather significant inflation problems, inflation problem which we don't have in the United States. So shorter term, the next 6 to 12 months, there's going to be a lot of headwinds, which gives us a little bit more confidence in the United States. But I think anybody that's got 2 or 3, 5 years out, they clearly want to be in your portfolio, and you might want to lean into opportunities as they present themselves in emerging markets.
Now, is a day like this, a down 175 kind of day, a day where you're actually deploying some of your cash?
We would be. We'd be looking at opportunities. The market is, depending where you're looking, 6, 7, 8, 9% cheaper than it was 6, 8 weeks ago. So those are opportunities to get into specific sectors and specific names.
Now, here's the catch, though. It can keep getting cheaper, right?
It can keep getting cheaper. And those are the value trap considerations. But if you've done your homework, it's kind of like being being a coach of a football team. You script out your plays. If you get defense A, you know what you're going to run. So given the sell-off within specific sectors, you have a pretty good idea what you would like to buy when your valuation targets are hit.
Hey, Stephen, I'm wondering if you like financials, and I want to bring Julie in right now, because, Jules, you've been talking banks for us big time today.
I have indeed. I mean, the value trap question is alive and well when it comes to the financials. And remember, I was talking earlier about Brad Hintz of Bernstein, who looked at Morgan Stanley specifically, and he says the stock is so cheap right now that even if you liquidated the company, even if you marked down everything on their books and sold it off, it would still be worth more than where it is right now. On the flip side, you still have a lot of uncertainties regarding regulation. So, Steve, I'm curious, do you agree with Hintz that a lot of these financials are undervalued, or do you think that the looming regulation is still too much of an unknown?
I would have to lean into the valuation being attractive, and the regulatory environment is getting more clear. It's certainly less unclear than it was a year ago. We've got Basel III. We know what that looks like. There's actually some flesh being put on the bones of the FinReg that came out of the U.S. Congress just a couple of months ago. So I think there's less uncertainty, and I think also business models are becoming less unclear. So balance sheets are cleaner. Right now, the Federal Reserve is basically allowing banks to borrow at 0%, and whatever they're investing in right now is just pure profit for them right now. So they're really repairing those balance sheets. And again, this is going to be a stock picker's environment. You need to scour balance sheet by balance sheet, business model by business model, and that old traditional banking model of banks actually having depository customers and then lending that out based upon credit quality. I think that may not be a great earner, but it's going to be a consistent earner. So if you know what you're looking at financials, I think you're beginning to create a story.
So in other words, some of the small traditional lenders, a People's Bank, a Hudson Bankshares, in other words, guys who keep loans on the portfolio who aren't syndicating them out.
Correct. And also if you look at banks that are just too big to fail. We know that there's an explicit and implicit backing of the federal government globally, that when banks get into liquidity issues, they'll be provided with that liquidity. So I think we know that there's a real safety net in a lot of financials.
All right, if you're talking banks, you got to talk housing.
Okay.
What's your outlook on housing?
For residential housing?
Yes.
I don't think it's hit a bottom yet. Maybe we're in the process of divining a bottom, but we're certainly not there yet. And once we do find that bottom, it's going to be a long time before housing prices go upward. You know, you just have too many houses, and it's not really a financing issue. You know, for a house that
you can get a loan.
You can get a loan, but if you've got a house which you can't afford the note, which is dropping in value, a 0% mortgage might be too high of an interest rate. So you've just got to clear this inventory overhang out there. Too many houses were built in the boom times. We need to flush that inventory out, and that's going to take a while.
Hey, guys, I want to go back to stocks and bonds, if I may. Actually, I want to bring bonds into it because, Suzanne, you, I think, are looking at stocks that actually act like bonds. What do you got?
Yeah, you know, the team at ISI put out a great note about just that, stocks that are like bonds. It gives you actually the best of both worlds. So, Steve, you know, you talk a lot about doing your homework and picking the right companies. What's your view on dividends? What sector is going to pay out the dividends? The financials, as we know, have not been so great about that in the past year or so.
Yeah, well, they've been restrained by a regulation from paying out dividends for many financials, and that's something that has changed. So that dividend situation within financials would be one of those opportunities to get some income generation within a portfolio. And I think dividends are going to be something that investors need to look at. In a low interest rate environment where we are now, you need to find yield, and that's going to be difficult to find. And many equities and equity-like instruments are probably generating a dividend yield which is competitive with an interest rate that you're going to get in fixed income. And you're going to need to look globally again to find credit risk in your fixed income, which is going to be able to generate that return that you need, that yield that you need. So I think dividends are going to be something that investors are going to be more interested in.
You know, Steve, only 30 seconds. You talk about a value trap. Are there dividend traps like AT&T, Verizon, Philip Morris, et cetera? They pay big dividends, 5-6%. But again, 30 seconds, do you get trapped in these names? They don't go up?
Without talking about specific names, the dividend trap is something that you see in bear markets and markets that have a lot of volatility. So that they might look like a great percentage dividend right as they're about to cut the dividend, or might not be able to defend it. It's the consistency of the dividend, the ability to continue paying and defend that dividend that's going to be very critical.
All right, Steve, got to do your homework, Carol. That's a story.